Well, unsurprisingly, the BOC delivered an early Christmas present today, and that's interest rates remaining pat at 5% overnight rate, again for the third time. But that's not why you're going to want to stay tuned to this video, because we're going to cover, of course, what actually happened and why it happened, but more importantly, what the expectations are for interest rates over the next 12 months, including some huge predictions, and last but not least, my suggestions for what could happen in the real estate market in the next 12 months in major cities. So, as we suggested, the Bank of Canada has decided to hold pat and keep interest rates exactly the same for the third time in a row. On December 6, 2023, the BOC decided, let's hold interest rates exactly the same. And this is a massive sigh of relief for those who are on a variable rate mortgage, adjustable rate mortgage, a line of credit, or anything else that's basically where your payment is based on prime. Basically what this means is you won't see any increases or decreases to your monthly payment. It's going to remain exactly the same. Now, while some were hoping for a rate cut, it's a little bit premature for that, as the Bank of Canada waits to see restrictive tightening work and to watch to look out for what's going to happen over the next couple of months. Now, the next rate announcement is January 24th of 2024. And between here and there, the government will be looking out for a few key signals. Now, first and foremost, inflation is down as of right now at 3.1%, which is a good sign. And it's mostly propped up, interestingly enough, by mortgage costs, so interest, and rental rates. Rental rates on their own have come in at exorbitant numbers recently, and there have been reports showing that rental costs are actually eclipsing purchasing. So if you ever needed any more of a reason to purchase real estate, now is the time to do so. Of course, there are some other key considerations. GDP has remained relatively flat and in some cases have started contracting. And more importantly, if we look at the overall economy, we've looked at unemployment numbers at 5.8% recently, but what the BOC is looking for is to see those unemployment numbers continue to go up closer to 6.5%. When they hit those numbers, you'll start to see interest rates really start to tumble. What's interesting to note about that is we've also seen the actual wage earnings go up 3 to 4% at the same time we've seen unemployment go up. What this essentially means is that people are still earning money that are actively working because of the higher cost of living. And this is obviously a good sign for house prices if you're looking for a recovery, or if you're someone betting that this is near the bottom. Now, speaking of interest rates, we talked briefly about what to expect going forward, but what's happening right now in December 2023 is that fixed interest rates are starting to actually see a little bit of a tumble. Not as quick as they should be though. The bond markets are actually reacting, and we've seen the bond yields come in at between 0.5 to 0.6% of a reduction over the last few weeks alone. This is a massive dip in a very short period of time, and it can't be understated. Now, we haven't actually seen the banks completely absorb those interest rates for a lot of reasons. The only places we've actually seen active reductions in interest rates are 5-year fixed mortgages, particularly insured mortgages, which is where someone is buying a home with less than 5% down or switching their mortgage from one lender to another within their insurance. For everybody else buying with 20% down or uninsured over $1 million, refinance, rental property, you've seen some rate reductions, but not as much as we hope. Now, of course, most people right now are opting to take shorter term fixed loans, betting that the market is about to turn around in the next 12 to 36 months. And that's a good bet, because most of the major banks just recently came out with their predictions around interest rates. And each bank has suggested interest rate reductions of anywhere between 1.75% to 2.25%. Heck, CIBC even came out, Benjamin Tal, and said he's expecting 150 basis points of rate reductions, which is 1.5% in the next year alone. Now, I don't know about 150 basis points, but virtually everyone is expecting 1%, barring any other major unforeseen event, which probably could happen. I think there's a reasonable assumption to be made that interest rates could go down at least 1% by the end of next year, which is a great sign for those who are looking for payment relief. That being said, that's also a big sign for housing costs, because for those waiting for the bottom, it means we might have already missed it, or you might be in it right now, because the moment that we see that interest rates are going to start cutting, what happens is affordability and qualification goes up. Anytime you see interest rates go down by 1%, a qualification goes up by 8%. Now, don't listen to all those naysayers. Of course, there are some people who are losing jobs, and there are some people going through some tough times right now, but we have a massive supply issue. And with demand as high as it is right now, regardless as to what anyone says, house prices will continue to go back up if interest rates come down, if for no other reason than what people qualify for. What's smart to look for though is what types of properties and what types of locations. There will be an interesting shift over the next couple of years as each province and of course the country of Canada is looking to change how they shape the country and building. Now, if I were looking to invest today, I would certainly be looking for a single family home, and I would be looking for an area that's been hit harder than most others in the last year alone. Of Of course, going forward, if you're in a position where you're in a tough time or you're struggling with your monthly payments, it's important to reach out because it could be only 6 to 12, maybe 24 months of recovery before we can put you in a better position. We could look at a second mortgage or refinance or a lot of other types of products to help you basically make it through these times. Of course, over and above that, my predictions for house prices is that we'll see things remain relatively flat over the next 2 to 3 months, barring anything massive or unforeseen. We'll start to see an increase or a tick up as activity continues to grow in the spring markets. Now, for a lot of people, you also have mortgage renewals that are coming up, and for those people that are coming up for mortgage renewals, there will be payment shock. That being said, most people will have the ability to refinance their actual mortgage to reduce their payments, reduce debts, or reduce overall costs, which should prevent any kind of major housing collapse that some of the naysayers are actually predicting in this here market. With that all being said, there's a lot going on right now, and there's even more coming up. So if you're loving this content, again, hit that like, hit that subscribe, and we'll see you on the next one.